Welcome to video 2 of part 3 of the EA Tax Training free EA exam preparation course for 2026. Tom here, back with you to discuss representation before the IRS. In video 1, we learned that as an EA, you can represent clients before the IRS. But what does that really mean? And how do you go about it? This video and the next will get into the nitty-gritty about representation. In this video, we will talk about the power of attorney, preliminary work when you are representing a client, the taxpayer's financial situation and how that affects your representation, legal authority and references, the statute of limitations, and then some related issues. Our free resources from irs.gov, the first two you'll see in every video in part 3. Talked about them before. Circular 230, Publication 947, must-haves. And then also in bold, meaning you should have it, is Form 2848, Power of Attorney, and its instructions. Not very long, and we will look at this in detail, but you will want to get your own copy of Form 2848 and then also read through the instructions. Speaking of the power of attorney, let's get started with that. As we learned in video 1, a taxpayer can represent themselves before the IRS, or they may authorize an individual to represent them. That could be you. And a power of attorney, or POA, is a taxpayer's written authorization for an individual to receive the taxpayer's confidential tax information and to perform certain actions on their behalf. If the authorization is not limited, the representative can generally perform all the acts the taxpayer could perform except negotiating or endorsing a check. Do we ever negotiate a client's check? No. And also, usually, you cannot sign an income tax return, though there are some exceptions to that, and we will talk about those. And the POA is filed using this Form 2848, which is called Power of Attorney and Declaration of Representative. So basically, what you are going to do is you will fill out this 2848, which we are going to show you. And then you are going to sign it as the representative. Then you will send it to your client, and then they will sign it. And then you will send it to the IRS. Once you do that, then you can essentially act as the taxpayer for most purposes when you are interacting with the Internal Revenue Service. So instead of the taxpayer having to do everything, having to talk to the IRS, having to go to conferences with the IRS, they can still go if they want to. But if they don't want to, you can just go instead, or at least you can be there with them. So think of it in a non-tax setting. If you were hiring an attorney, the attorney can speak and act on your behalf. So this is the same thing. It is a power of attorney. So you can act on the taxpayer's behalf, but you still cannot negotiate a check or redirect their money into your bank account. That is still not allowed. And you can't sign a tax return on their behalf in most instances. So when you, as a representative, have a power of attorney, you can do the following things. You can represent the taxpayer before any office or employee of the IRS. You can sign an offer or a waiver of restriction on assessment or collection of a tax deficiency, or a waiver of notice of disallowance of a claim for credit or refund. You can sign a consent to extend the statutory time period for assessment or collection of tax. So we're going to be talking about in this video the statute of limitations. So there can be times when you are negotiating with the IRS when you actually extend the time the IRS has to assess or collect tax. And you have the power to do that. You can also sign a closing agreement. So when there is an audit or an examination, at the end, the IRS agent will write up a closing agreement that has all of their conclusions and everything that you've negotiated with them and what the final outcome of that audit is going to be. And you, as the representative, have the power to sign that on the taxpayer's behalf. As we said, even with a power of attorney, usually you cannot sign an income tax return for a client. They need to do that themselves. There is an exception, though. If the signature, your signature, is permitted under the Internal Revenue Code, and if the taxpayer has specifically authorized you to sign their tax return. So it's not part of the normal powers of the Form 2848. But as we'll see, there's a box they can check that does give you the power to sign on their behalf. So if both of those things occur, it's allowed under the Internal Revenue Code, and the taxpayer has specifically allowed you to sign it, then you can sign the tax return on their behalf. So when does the Internal Revenue Code allow you to sign on their behalf? Well, there are a few instances when you can do that. If the taxpayer themselves cannot sign due to disease or injury, then you can sign on their behalf if you have authorization to do that. If the taxpayer has been continuously absent from the United States for at least 60 days prior to the required filing date, then you can sign on their behalf. And their absence can be, in this instance, for any reason. It doesn't have to be for employment purposes or anything like that. It's just if they are continuously absent for at least those 60 days, then you can sign on their behalf if you've been given that authorization. Or for other good cause, if you ask the IRS and they grant that. So there could be other circumstances that are unforeseen, and you can ask the IRS for permission to sign, and then they may or may not grant that. With the Form 2848, it must be filled out correctly or it will be rejected by the IRS, and the power of attorney will not be in effect. So sometimes if you make a mistake on a regular tax return, like on a 1040, oftentimes the IRS will just either overlook the mistake or they'll make some correction for you, and then they will send the taxpayer a letter that says, look, we corrected this and there's nothing else for you to do. With the 2848, that is not the case. You need to get it right or they will just reject it. And there can be times when these are very time sensitive, like the taxpayer has gotten a notice from the IRS, they have to respond within a certain number of days, and you need to get this power of attorney done so that you can respond in a timely manner. So you want to make sure that this is completed correctly. As we mentioned in video 1, only individuals can be named as representatives for a power of attorney, not firms or companies. So it can't be your whole firm that is appointed. It can only be specific individuals. It can be more than one, but it has to be individuals who qualify, who are attorneys, CPAs, or enrolled agents in order to be on the power of attorney. And those individuals' names, business address, PTIN, telephone number, fax number, and something called a CAF number, if applicable, must also be provided. We'll look at that. And then the acts authorized must be specific. For example, it can't just say you have authorization to represent the taxpayer for all tax returns for all years. That is not allowed. It has to say, for example, income tax for Form 1040 for the years 2022 and 2023. That would be specific and allow that representation. The 2848 must be signed by both the taxpayer and you as the representative. Those signatures must be handwritten if this 2848 is filed by mail or fax. There can only be an electronic signature if the 2848 is being filed electronically. Now, you might say, well, in this day and age, why would you be filing it by mail or fax? Why not just always file it electronically? Well, what happens a lot is the taxpayer gets one of those notices from the IRS, and you can only respond to many of those notices either by mail or fax. So what you will do as a representative is you will either mail or fax in that response to the notice, and you will include with that the Form 2848. So then those signatures do have to be hand signatures. Now, they don't have to be original, meaning you can send a copy to the client. They can sign it by hand, scan it, send it back to you, and then you can send that scanned copy into the IRS as long as that signature was done by hand, both the taxpayer's signature and the representative's signature. And I have seen these 2848s rejected for this reason, and I've seen it more than once. So they're not fooling around. And remember, we said When you do the 2848, you want to do it right. So this is one of those parts of doing it right. So let's have a look at the 2848 itself so you can see exactly what it looks like. Up here in part 1 is going to be the taxpayer's information, their name, address, etc. And then section 2 of part 1 is representative's information. So this is where you put your name and business address, your CAF number, if you have one, we'll talk about that, your PTIN, telephone number, etc. If you have had a change of address or telephone number or fax number since the last time you filed a 2848 for any client, not just for this client, then you will want to check the box that if there's been a change, so then the IRS knows they need to update their records. And then you'll see here, this box, check if to be sent copies of notices and communications. So there is room on this form for up to 4 people to be named as representatives. And you could actually name more if you wanted to. You could just attach another copy of the 2848 with the extra names, but usually there's no need to have more than 4. But up to 2 of those people, you can check this box so that any correspondence that is being sent to the client regarding any of the issues for which you are given power of attorney on this form, copies of that correspondence will also be sent to those representatives for whom this box has been checked. So this is nice. This way you don't have to rely on the client getting the communication and then remembering to send it to you. You will also get a copy of that, so you will already have it, and then you can take action on it right away. So you put all of the information for all of the representatives. If it's just you, then this is just going to be your information. You'll want to check that box, and then you will be done with it. If you've got multiple people, then you fill out everyone's information. And then 3 here is acts authorized. So this is a generic statement about what the power of attorney does. And then you need to put the specifics. This is what we talked about before. You have to be specific. So here it would be description of matter, and they give you examples of what you can put: income tax or employment tax. So you would write that in here. You could put income or income tax. Then the tax form number, maybe you put the 1040 or 1120S or whatever the case may be. And then you will put the tax year. So let's say there's been an audit and it is year 2023 that's been audited, and that's what you are representing the client for. So you would put 2023 in here. It can be multiple years. It might be 2022 and 2023. That's fine. You just can't leave it open-ended or put all years. That is not allowed. And then line 4 here is specific use not recorded on the centralized authorization file. So that's that CAF we were talking about. We will talk more about that later, but this is a box you can check if you don't want the IRS to add this particular 2848 to the centralized authorization file. And then line 5 is additional acts authorized. So if there's nothing checked here, then you will have all the normal powers that you have with a power of attorney, but you won't have any additional powers. So if the taxpayer wants to give you additional powers, this is where they do it. So for example, if they want to give you the authority to sign a return on their behalf, assuming that it is allowed by the Internal Revenue Code, then they would check this box, or actually you're going to be filling it out. So you check the box and then the taxpayer signs. And then there's other things. For instance, substitute or add representatives. If you work for a firm and you are naming several people on this power of attorney, people come and go from firms. They quit or resign, and other people are hired. And so there are times when you might want to substitute or add representatives. So this gives you the power. Check this box. Then you have the power to just substitute people without having to have the client sign every time you're going to put a new person on this power of attorney. And then you can see a few other boxes that can be checked as well. And then there's also this other acts authorized. So if there's something that's not mentioned here that the client wants to give you the authority to do, they could check this box and then write out what that is. Then we will go to page 2, and you'll see this is a continuation of the previous line, specific acts not authorized. So if there's anything that the client wants to make clear that you do not have authorization to do, then they can write that in here. Then retention or revocation of a prior power of attorney. So we'll talk about this a little bit later. But if you file a power of attorney, then any other power of attorneys that are already in existence. So, for example, there might be another representative who already has a power of attorney for this specific type of tax in this specific year. Well, that will automatically be revoked for that other representative unless you check this box. And if you do check the box, then you must attach a copy of that other power of attorney. So that other Form 2848 for that other representative, you have to attach a copy to the new form. And then finally, this is the taxpayer's declaration and signature. So they sign and date, put their title if it's an organization. So maybe they're the president and CEO. So they would put that there and then they would print their name. Part 2 is the declaration of the representative. So that is you. So you are saying here, yes, I am eligible to practice before the IRS. I have not been suspended or disbarred, etc. So basically, you're saying I am legit. That's what this is saying. And then you are one of the following. So attorney, certified public accountant, enrolled agent. You are an enrolled agent. So you are C. You will want to remember that because you're going to need to put that down here further on the form. And this is where you're going to do it. So here you've got 4 spots for the representatives. Remember, there were 4 spaces on the previous page. So these are going to correspond in order. You want to put them in the same order as the people listed on page 1. And you will put what is your designation. So that's where you're going to put the C for enrolled agent. Then your licensing jurisdiction is going to be IRS. Then you're going to put your EA number. So when you become an enrolled agent, the IRS will send you a number. You will put that here. Then you will sign, if you're doing this by mail or fax, then you will hand sign it and date it. If you've got multiple representatives, they all need to sign it and date it. The Centralized Authorization File, or CAF. So, information from power of attorneys that are submitted on the Form 2848 and accepted by the IRS are entered into the CAF system. So, this system is a computer system that contains the information regarding the authority of individuals appointed under the powers of attorney. It does not, though, contain a copy of the power of attorney itself. So, this is how the IRS keeps track of who has a power of attorney for which clients and for which forms and years and all of that. So when you call in to the IRS, they need to know whether or not they are authorized to talk to you. So what they will do is they will ask for your name and your PTIN, and then they will ask you a series of questions to verify that you are who you say you are, and they will look in their CAF system to make sure that you actually do have authorization to speak to them on the client's behalf for this matter. So that's what the CAF system is for. The first time you fill out a 2848 and your name is included there, the IRS will issue you a CAF number, and then they will send that to you in the mail. And then on future 2848s for any client. So the CAF number is assigned to you. It's not client specific or taxpayer specific. So once you have a CAF number for future POAs, you will put that CAF number on there, and then they will add that to your file. There are certain one-time and limited authority POAs that are not entered into the system. So this is that checkbox we talked about. So sometimes you're doing something for a client. It's a one-off thing. You're never going to have to deal with it again. You can check that box so the IRS doesn't waste their time adding you to the CAF system. Alternate form of power of attorney. So in the real world, 99 point something percent of the time, you are going to do a power of attorney on the Form 2848. But you need to know for the exam that you don't have to necessarily do it on the 2848. you can have a power of attorney that is done just, for instance, on blank paper. So it can be a signed statement from the taxpayer, including all the information on the Form 2848, and then you attach that instead of the 2848 when you are dealing with the IRS. So the client can go, for instance, to an attorney. The attorney can write up power of attorney just on blank paper. As long as it has all the same information as the 2848, then that is fine and it will be accepted. However, if you want that added into the CAF system so the IRS knows that you've got authorization to talk to the client, then you're going to have to fill out the 2848 anyway. You're going to have to put all the same information on there. The only difference is the taxpayer does not have to sign that 2848 because they've already signed the other power of attorney, but you do have to sign the 2848. So you would send in both the power of attorney that the lawyer wrote up and the 2848 that you wrote up with your signature on it. You would send both of those if you want to have it in the CAF system. Again, in the real world, you're probably never going to have to deal with this, but you need to know it for the exam. Withdrawing or changing a power of attorney. So a power of attorney is valid until it is either revoked by the taxpayer or until you as a representative withdraw. If the taxpayer wants to revoke it, they can do that, but they have to do it in writing. And the way that they would do that is they would get a copy of the first page of the 2848, and they would write the word revoke across the top, and then they would sign it and date it, and then they would send that to the IRS. If they don't have a copy of the 2848, then they can just send the IRS a signed written statement revoking the authorization. In order to withdraw, you would do essentially the same thing as the representative. You would get page 1 of the 2848, write withdraw across it, sign it and date it, and then you would send it in. And the same thing, if you don't have a copy of it for some reason, then you could just do that as a written statement that was signed and dated. A newly signed and filed power of attorney concerning the same matter, same years, will automatically revoke a previously filed power of attorney, as we said when we were looking at the form. And it will do that unless the taxpayer specifically attaches a statement that says otherwise, or they specifically check that box. If they check that box, that counts. But as we said, you then have to attach a copy of the previous 2848 to the return. So this can happen. Sometimes they're going to hire both an attorney and you to represent them in a matter, for example, and they want both of you to have the power to talk to the IRS about it. So that's fine. They could have both of you in effect. Or it could be a payroll tax return, and maybe they have a company that does their payroll tax for them. And so that payroll company, somebody there, has a power of attorney in place to talk to the IRS specifically about their payroll tax return. And they now want to give you the authority. Maybe there's been some question about that payroll tax return and they want you to help represent them. So they might want to give you a power of attorney and also keep the payroll company representative as a power of attorney. So this is another case where you might do this. Any changes or updates to the power of attorney must be made in writing and they have to be signed. If the taxpayer has given you as a representative the authority to add or substitute new representatives, then you as the representative may do so by submitting the changes in writing to the IRS. So remember, that's that box where we said if they check that box, then you can just add or delete people from your firm without having to have the taxpayer sign off on that every time. Once they give you the authority to do that, then you can do that, although you do still have to do it in writing. You can't just call the IRS and do that. You have to send it in writing. You would want to put in there a copy of the power of attorney so that they can verify that, yes, this person has the authority to add and subtract people from the list, but that makes it a lot more convenient than having to have the taxpayer sign every time. Form 8821. So this is a lower level of authority than the 2848. So there's no power of attorney needed or given by this Form 8821. But what it does is it authorizes a third party to receive information from the IRS from specific years in tax returns, but it does not authorize representation. So, for instance, the taxpayer might be getting a mortgage, and the mortgage company wants to receive information straight from the IRS, and the taxpayer allows that. They can sign the Form 8821, giving the person at the mortgage company the authorization to receive that. Or it could be a bank or an employer or even a tax return preparer. Maybe you're new to this client, you're just now starting to prepare their tax returns, and you want to get information from the IRS, but you don't need a full power of attorney. You could do an 8821 so that you can receive that information. Third-party designees. So you remember back in part 1 on the 1040, there's that box right above the signature block that says, yes, I give the IRS the permission to talk to the person named below. And then you put your name as the tax preparer there. So no power of attorney is required for that. However, your authority is limited to discussing and receiving information about that one tax return. It's more limited than the 8821 because the 8821 can authorize multiple years and different types of tax returns. And this checkbox is only for this one tax return for this 1 year. And of course, the third party still cannot receive a tax refund check on behalf of the client. Client privacy. Practitioners are required to keep all client tax return information strictly confidential. It is a crime to knowingly disclose it. Remember, we talked about penalties you can have, both civil and criminal, for disclosing tax information when you're not supposed to. We talked about that in video 1. And then also, it can be a civil violation, not a criminal one, but it can be a civil violation even if the disclosure is not done knowingly or recklessly. So you can be sanctioned or fined even if you don't do it on purpose. So if someone breaks into your system, hacks in to your system, you could potentially be liable for that disclosure, even though you did not do it knowingly or willingly. So we'll talk about data security a little bit, but that is something to keep in mind. But this whole idea of confidentiality is very important. Your clients are your clients. You do not share that information with anyone. I drive my wife crazy with this. It's kind of a running joke. I do the tax returns for several members of her family, and I refuse to discuss any of the information on those tax returns with her. I just won't do it. Now, most of her family members probably wouldn't care if I did, but it doesn't matter. If they want to talk to her about it, that's fine. That's their business, but I am not going to be the one who does it. So this is a very serious matter. You don't discuss this information with anyone that you are not allowed to discuss the information with. Now, having said all of that, of course, there are going to be exceptions. It wouldn't be a rule if there were not exceptions. So there are times when you can share the information. And the first one is if the client has given their written consent for you to do so. In order to have written consent, it has to meet all kinds of different criteria that you see on your screen here. It has to have the purpose of the disclosure, the names of the people involved. There's some mandatory language that needs to be on there, and you can see the rest here. You can read that for yourself. But if you have all of that, so the client in writing meets all this criteria, has said it's okay for you to disclose it, then you can, in fact, disclose it. There is another exception. So a practitioner can disclose information to a second taxpayer who appears on the tax return. So if their name and information is on the tax return, you can disclose information from that tax return to them as long as the second taxpayer is related to the first taxpayer, such as being spouse, child, grandchild, parent, grandparent, a general partner in a partnership, or a beneficiary for a trust, and the first taxpayer's interests are not adverse to that second taxpayer, and the first taxpayer has not prohibited the disclosures. And then other exceptions. No consent is required to disclose information in the following circumstances if it is subject to a court order or subpoena. So if you get a court order or a subpoena, you should check with an attorney anyway, but that is one of the exceptions you want to know for the exam. If there is an administrative order or subpoena from a federal or state agency or commission charged with licensing or regulating tax preparers. So maybe you are being investigated by some state board, and you may need to, as part of that investigation, disclose information. If they give you an order or a subpoena to submit that information, then you can do it. If you are reporting a crime to the authorities, then you can disclose it. Again, you'd want to check with an attorney in the real world. But for the exam, you need to know if you are reporting a crime to the authorities, then you can disclose as part of a peer review process. So, for example, larger CPA firms have to undergo a peer review process every few years. That's when another CPA firm comes in, looks at all their processes and procedures, and it's going to review some of their work. They're going to review their audits. They're going to review some of their tax returns and some of their consulting engagements to make sure that they're following all industry best practices and all of that. In that case, of course, that other firm is going to need to look at some of those tax returns. And so you can disclose in that case. And then you can also disclose to your attorney or to an employee of the IRS in connection with an IRS investigation of the preparer. So in the first video in part 3, we talked about the OPR, where they might investigate you. So as part of that, you may need to disclose to your attorney or to the IRS some information to defend yourself. And so you are allowed to do that. Electronic data. So practitioners should follow industry best practices to keep client data secure. So this is very important, and it's becoming more and more important all of the time. You must have a written information security plan, or WISP, they call it, in place, and you must follow it. So you have to have a plan in place. How are we going to protect this client taxpayer information? And then you have to follow that plan. And of course, you should always be aware of phishing and other scams that are designed to steal this information. And this is real. These are out there. I'm sure you've seen it in your personal life when you get these emails trying to get your information, you get text messages trying to get your information, even phone calls. Well, that happens for tax preparers as well, and you need to be prepared for it. So let me give you an example, real world examples. There is hardly a week that goes by, and during tax season, it's hardly a day that goes by when I do not get an email from someone, some person I've never heard of, asking me to prepare their tax returns. When you become an enrolled agent, you're going to have the opportunity to have your name and information printed in a public database so that if clients are looking for a tax preparer in their area, they can go in and they can find someone and they can start doing the research on those people and contact them to possibly prepare their taxes. So obviously that is public information. So what the scammers do is they will get your name and your email address from that database, and then they will send you emails. And they'll say, hi, I've got this tax return I need done. And a lot of times it'll be multiple years. And it could be multiple entities. So they might say, yeah, I've got a S corporation and I need somebody to do my tax returns for the last 2 years for both my own 1040 and for the 1120S for my S corporation. And then a lot of times what they'll do is they will have a link in there. They'll either say, okay, my information, my W-2s are attached, or here's a link to my Dropbox where I've got all the information for my companies and for my personal stuff. Or it might have a phone number and they'll say, here's my phone number, give me a call so we can discuss. And then when you call, they're going to say, oh, yeah, I've got all my information. If you can have a quick look at it, here, I'll send you the Dropbox link or whatever. So they're trying to get you to click on this so that they can steal your information and or your client's information. Now, when you are a new tax preparer, you're going to be hungry for business, especially if you're working for yourself. So you're going to get one of these emails and you might be excited, might be thinking, wow, yes, this is great. I've got a new client here. And in your excitement and enthusiasm, you go ahead and click on something and then you're done for. So I want to warn you about this. I know you're excited. I know you want new business, but you need to think about this. Think before you act. If you needed someone to do your tax return, would you just pick a name out of a database and just send them all of your confidential information without ever interviewing them, talking to them, vetting them to make sure they're a good tax preparer? Well, of course you would not do that, and neither would they. So it is clearly a scam. Now, this is different than if you get an email that says, hey, Tom, I was talking to Joe. He's a friend of mine, and he said that you do his taxes. I need some tax help. Can you help me? Here's my number. Please give me a call. Well, that sounds like it might be legit. Now, what I would still do is I would call Joe and I'd say, hey, Joe, I got this email from this person and they're asking me to do their tax return. They said they're a friend of yours. And then Joe says, oh, yeah. Oh, yeah, that's my best friend from high school. And we were at a party this weekend. And he was talking about his taxes. And I told him you were great. And I gave him your name. And then you can say, well, thank you so much. I appreciate it. Now you can thank Joe for the referral. You can connect again with him. You can talk to him. And you know that this is a legitimate lead. That's great. In that case, you may actually have a real client. But if you're just getting these out of the blue and it seems this is too good to be true, then it probably is. I will tell you, I get these now. I glance at them and I just delete and block. But no matter how many times you block them, they keep sending them from different email addresses, but I still do it. Delete and block. I don't even look at them anymore. So be aware of that. And it could be, it's not just email anymore. They're texting now. Hey, I want you to do my tax return, and here, click on this link, or give me a call, or whatever. Be very suspicious of that. Again, never click on a link. No way. If you think maybe it's legit and you want to call them, you can try to judge for yourself. But I would never, again, if they're trying to get you to go click on something while you're on the phone with them, absolutely, positively not. Or to give them some information like, well, can you tell me what is your EFIN? We'll talk about that later, your electronic filing identification number. I need your EFIN. I want to check you out or something. You would never give that. Or your PTIN. They say, what's your PTIN? Don't give them any information like that. Sounds like a scam. So just be wary of this and don't fall for it. Practitioner confidentiality privilege. Mentioned this several times in video 1, so let's talk about it in more detail. With respect to tax advice, the same common law protections of confidentiality, which apply between a taxpayer and an attorney, also apply to a taxpayer and any federally authorized tax practitioner. That comes from Code Section 7525. Now, this applies only in non-criminal matters. So if it is a criminal proceeding, then this practitioner confidentiality does not exist. And that's true, by the way, even for actual attorneys, for information provided to them for purposes of preparing a tax return. So if they went to the attorney just to have their tax return done, and then something comes up in the course of that, and the attorney realizes, oh, there's been a crime potentially committed here, there actually is no attorney-client privilege for that attorney in that case. Now, obviously, if the taxpayer went to the attorney because they committed the crime, then there would be an attorney-client privilege. If they come to you and you're not an attorney and they've committed a crime, well, there is no attorney-client privilege because you are not an attorney. There could be cases, though, where the person has gone to an attorney, so there is an attorney-client privilege, and now the attorney is going to hire you to help with that. And then in that case, you would fall under the attorney-client privilege. But if it's just the client coming to you and hiring you, and then turns out there's been a crime committed, no privilege. And also, the confidentiality does not apply to tax shelter matters. So remember, we talked about those abusive or potentially abusive tax shelters. So there is no confidentiality when it comes to those. But in the vast majority of cases, so we've talked about the exceptions here when there's a crime or when it's a tax shelter. But most of the time, we're not dealing with that. So most of the time, when you're dealing with a client, you have this same common law protection of confidentiality that apply between a taxpayer and an attorney. So you always want to keep that in mind. Preliminary work. So when you are first representing a client for the IRS, so especially if they're not an existing client, they're coming to you specifically for representation. What are the steps that you need to take? What do you need to do? So that's what we're going to talk about in this section. When you are beginning an engagement, or before you even begin it sometimes, there are basic steps that you need to take. First of all, you need to gather and review all the facts and documents related to the case. So this includes a detailed interview of the client and any potential witnesses or experts. Then you are going to identify, once you do that, you're going to identify the tax issues that are involved. You're going to consider the possibility of criminal aspects and if the client should retain an attorney. You're going to consider your own competence or expertise in this particular matter and whether or not you have the ability and time to handle the issue. So we talked about competence in the previous video. So you need to consider, am I competent to represent this taxpayer in this matter, or can I quickly become competent? So you want to make sure that you are. And then, do you have the time? So it's going to depend on how busy you are and what the time frame for this representation is. If they come to you in the middle of March and they've gotten a letter from the IRS and they're bringing it to you and you're supposed to respond to this letter within the next 2 days because they waited to bring the letter to you and maybe you had 30 days from the date on the letter to respond. Now you've only got 2 days left. You're in the middle of tax season. You've got a zillion things to do. You may not have time to help this client. And so you're just going to have to tell them that. But you need to gauge that before you start the work. And then you need to verify that you don't have a conflict and that no members of your firm have a conflict of interest in order to work with this client. Financial documents. So back in part 1, you'll remember when we talked about when you're just going to do a tax return, there's certain documents you need to get. Well, this is a similar concept. When a client comes to you for representation, there are certain financial documents and expense records that you may need. So, for example, canceled checks and bank statements, brokerage statements, receipts, accounting records that the client has, etc. So all of those things, you're going to want to get those documents. There can also be legal documents that you need: birth and death certificates, divorce decrees, lawsuits and settlements, closing documents from real estate, corporate minutes and board authorizations. It's always a good idea if you're dealing with a business entity to get those documents like the partnership agreement or the corporate bylaws or the operating agreement for the LLC and anything else that you might need for the particular matter for which you are representing this client. Usually you're going to want to get copies of tax returns. So you're certainly going to want to have a copy of the return for the year or years in question. It's also a good idea to get returns for a year or more before and a year or more after, because there's a lot of carryover items and you want to see what's happened between the years. You may need both corporate and partnership returns as well as the individual Form 1040s. So maybe you have a client who their 1040 is being audited, but they are a shareholder in an S corporation, for example, or a partner in a partnership. And the K1s they get, the income that they get or loss, is relevant to the audit. So you may need then a copy of the Form 1120S or the 1065, in addition to the client's individual Form 1040. And then sometimes you may want to get a tax transcript instead of or in addition to a copy of the tax return. So let's talk about those transcripts. If you did not prepare the tax returns at issue, you want to get a copy of them, but you'll also want to go and get a transcript so you can see what was actually filed with the IRS. You want to make sure that the tax return copy that you're looking at, that all the information is the same that the IRS has on file. So you say, well, why would that be different? Well, there could be a variety of reasons why it's different. But one of the common ones is that there was some sort of amendment done to that tax return and you don't have a copy of that amended return, or the client doesn't give you a copy or doesn't even know the amended return exists. Or maybe the IRS made an adjustment. So there was an error made and the IRS got the return, they noticed the error and they just adjusted it themselves. So you want to make sure that you are looking at the right information so you can get a transcript. What a transcript does is it shows a line by line breakdown of the numbers on the tax return. So it's almost as good as having a copy of the tax return itself. I'd still want to have a copy of the tax return if I can get it, but the transcript is almost as good. And as I said, sometimes you're going to want it in addition to the tax return. By taking advantage of this online system, e-services, you can get the transcripts of the client's tax return, and it is easy to do. So let's show you that. You're going to go to irs.gov/tax-professionals, and you're going to see something that says Access e-services, and then they have this TDS, the Transcript Delivery System. So you can see it looks like this. The button says Access TDS. And this is where you can get the transcripts. So you do have to have the power of attorney or an 8821 in order to get this. But as long as you have that, then you can get this through their system. And then this is a sample of what it looks like. This is just page 1, but it'll show you all the taxpayers' information and then their filing status, etc. And then it's going to give you line by line all of the dollar amounts. And then these are usually 3 or 4 pages long. So you will have all of the information that the IRS has for that tax return. If you want to get actual copies of the return from the IRS, so maybe the client doesn't have them, you can request those on this Form 4506. You can also request a transcript by mail rather than getting electronically on a 4506T. So what you do for the 4506 is you fill it out and you can request returns for the past 6 years. So if it was prior to 6 years ago, you're not going to be able to get it. But if it's within the last 6 years, you can. It does cost $30 per return, and then you can get a copy of that return. Or you can get a transcript. I would just do it electronically. So this is just for information to know that this is available, but you can get a copy of the transcript. However, they will not send it to you even if you have a POA. They will only send it to the taxpayer's address in the case of a transcript. Next, we'll move on to talk about the taxpayer's financial situation and how that affects your representation. When you are representing a client before the IRS, the client's ability to pay is often a key issue. It's going to affect any offers in compromise, installment agreements, and collections in general. And we will talk about all of that, offers in compromise, etc., in our next video. But their ability to pay is obviously going to affect those things. For instance, if you've got a client just doesn't have any money, doesn't have any assets to speak of, doesn't have much income, well, you're in a pretty strong position as their representative. The taxpayer's in a strong position, actually, because the IRS knows they can't get blood from a turnip. But you're going to have to share with the IRS all of the taxpayers' detailed information. So you're going to have to get that for yourself. You will need a clear, detailed picture of their financial health, their income, their expenses, their cash flow, their assets, their liabilities, any potential liabilities. You need to know if they're in bankruptcy. You need to know if they're insolvent. So insolvent means they're not in bankruptcy, but their liabilities exceed their assets. Are there any garnishments that they have in place against them? Are there any lawsuits pending or already been settled that you need to know about? And you may need third-party information, such as asset appraisals, property tax assessments, or state and local tax information. So the information you're going to need, even if it's an individual, is very similar to the information that you would see on a business's financial statements. So assets and liabilities on a balance sheet, income and expenses on an income statement, cash flow on a statement of cash flows. So if you're dealing with a business, you may actually have financial statements that have this information on it. If you're dealing with an individual, you're going to have to put all of this together. Now, when we say you need third-party information such as appraisals, what do we mean? Well, for a business, for example, they will frequently have a balance sheet that lists their assets and their liabilities. But that's not going to be enough in this case. Why not? In accounting, for a balance sheet, when we are listing a business's assets, what is listed on the balance sheet is that asset's book value. So essentially, it's basis. So we learned about basis in part 2. So the basis of the assets, it's the cost of the assets with any adjustments that have been made. So if you bought something that's depreciable, then it's going to be the original cost minus any depreciation that's been taken. There can be additions, of course, as well, as we discussed. But the point is, what's on the balance sheet is the basis, not the fair market value. So that business could have, for example, a building that they bought 20 years ago, and the book value of that building as it stands now is, let's say it's $100,000. Well, the fair market value of that building could easily be $1 million, for example. But what shows up on the balance sheet is $100,000. But what we're talking about here is the ability of the client to pay any tax. So we need to know the actual value of that building and of all of the assets, not just the book value or the basis. So you may need an appraisal to know what those assets are worth. And of course, it can work the other way too. They could have a car that they just bought or a truck that they just bought that's actually worth less than the book value. So you need to know either way. IRS collection financial standards. So the IRS has certain standards that they use to help determine a taxpayer's ability to pay a delinquent tax liability. The allowable living expenses that they will allow you to report are those that are considered necessary to provide for the taxpayer and their family's health, welfare, and/or production of income. So if you've got a client who lives a very extravagant lifestyle, they are not going to be able to get credit, so to speak, for all of those extravagant expenses. They're only going to get credit for the necessary expenses in their life. And you're going to have to report all of this, by the way. If you're in one of these situations, there are forms that you're going to fill out where you're going to show the taxpayer's income, expenses, assets, and liabilities. We'll talk more about that in the next video. But for now, we just need to know that these standards exist and how they work. So when you are dealing with the client's expenses specifically, there are published local standards for housing, utilities, and transportation. So the IRS acknowledges that it is more expensive to live in some areas than others. So it's more expensive to live, for example, in New York City than it is in Little Rock, Arkansas. And so they take that into account. So they have these published standards by geographic region, like these metropolitan statistical areas. And it will say, here are the
amounts for rent, for example, in that particular area, for utilities in that particular area. So when you are filling out these forms and listing out the client's expenses, they are allowed the lesser of the local standard that's published by the IRS or the amount they actually pay. So if they pay rent and that rent is less than that local standard, they have to use the actual rent that they pay. But if their rent is higher than that local standard, they can only use the local standard. So that's for housing, utilities, and transportation. There are also published national standards for everything else, for food, clothing, healthcare, and other expenses. The national standards are the same everywhere. They don't give you credit for being more in certain parts of the country than other parts of the country. And for these, you're just going to use the national standards. So this is what they're allowed, regardless of the amount that's actually spent. So there's going to be a certain amount for food. And whether the client spends more than that or less than that, they're going to use the national standard. The same way for clothing and healthcare, etc. Bankruptcy. Filing bankruptcy stops all IRS tax assessment and collection efforts. So the IRS might be sending all kinds of letters threatening to put tax liens on the taxpayer's assets. All kinds of letters trying to collect this money. Once the taxpayer files bankruptcy, that stops. They are no longer allowed to do any of that. They cannot seize any assets. They can't threaten to seize any assets. They can't send any letters trying to collect money. It all stops. Certain tax debts may be discharged in bankruptcy, but they have to meet specific criteria. So in order for a tax debt to be discharged in bankruptcy, they have to relate to a tax return that was due at least 3 years before the bankruptcy filing. So you can't figure out that you got a big tax bill due for a tax return you just filed for last year, file bankruptcy, and have that discharged. It has to be an older debt. So it has to relate to a tax return that was due at least 3 years before the bankruptcy filing.
So let's think about what tax returns the amounts due might be dischargeable in bankruptcy. Let's say you have a client who files bankruptcy in March of 2025. How old of a tax return, how long ago, could potentially be discharged? Well, if you think about it, a 2021 tax return was due in April of 2022. So if they file bankruptcy in March of 2025, that is less than 3 years from when the 2021 tax return was due. So you would not be able to discharge a debt from a 2021 tax return for that March of 2025 bankruptcy. So it'd have to be 2020 or prior. Then the next criteria is that the tax return must have been filed at least 2 years before the bankruptcy filing. So we said a 2020 tax return could be eligible, but let's say that that 2020 return was not filed until 2024. Well, even though it's for the 2020 tax year, since it wasn't filed at least 2 years before the bankruptcy, would not be able to be discharged in bankruptcy. And then also the tax assessment must be at least 240 days old. So that's what, approximately 8 months, but you'd have to actually count 240 days. So let's say that that 2020 tax return was audited in 2024. And in December of 2024, the IRS assessed tax from that 2020 tax return. That assessment from December would not be at least 240 days old by March of 2025. Therefore, even though it relates to a 2020 tax return, that assessed amount from December would not be able to be discharged in bankruptcy. Now, maybe they owed amounts from 2020 with the tax return that they filed, and they haven't paid it yet. That amount could be discharged. But the amount from the audit
from the assessment that the IRS did in December of 2024, that amount would not be able to be discharged. And then also, the tax return cannot have been fraudulent or frivolous. If it was, doesn't matter when it was filed, not going to be able to discharge it. And the taxpayer cannot be guilty of tax evasion. Doesn't matter when it was, not going to be able to be discharged. You will want to remember these, especially these numbers. Tax return was due at least 3 years before. It must have been filed at least 2 years before the bankruptcy filing, and the assessment itself must be at least 240 days old. You will want to remember those. Our next topic is legal authority and references. So when you are representing a client, you're going to be doing tax research. And we talked about this in the first video. You're going to look at everything in the lens of what does the tax law and authority say. So that's what we're going to talk about here. When you are dealing with the IRS, you're going to need to be able to prove your client's position to them. You're going to need to show them some authority about why your position is correct. You're going to need more than your opinion. They don't care what you think or what I think, what anybody else thinks. They need to see what does the law say or what does IRS themselves say. So you are going to want to do your research and apply that law and those rules to your facts. So what you see listed here are authoritative sources. So these are sources that you can cite to the IRS agent to support your position, and they are in an approximate order of ultimate authority. So you're going to start at the top with the U.S. Constitution. In the United States, all legal authority comes from the Constitution, and we will look at that. However, when we're dealing with the IRS agents, rarely would we ever talk about the Constitution because it's not very specific. So, as a practical matter, the top dog, as far as authority goes, is the Internal Revenue Code, which is the tax law itself. Then you've got the Treasury regulations, legislative history, case law, and then various IRS positions. So we will talk about each of these. There are also non-authoritative sources. So these are ones that you would not necessarily cite to the IRS agent, but you can use them to do research and to point you to authoritative sources that you could then cite. So we have the Internal Revenue Manual, as well as IRS forms, instructions, and publications. We'll talk more about those. And then there are what are called secondary sources. So these are third-party research tools and books and databases that you can find. So some examples of the names you'll hear out there: BNA, CCH, RIA Checkpoint, LexisNexis, Westlaw, and there can be others. So what these can do is you can't ever point to them. You can't say, hey, look, CCH says this. But what they can do is to help you to understand the law and to point you to authoritative sources. So let's start with the Constitution itself. We saw this back in part 1, but we'll look at it again. The 16th Amendment to the Constitution was enacted in 1913, and it says, it's Article 16, the Congress shall have the power to lay and collect taxes on incomes from whatever source derived, without apportionment among the several states, and without regard to any census or enumeration. So previous to the 16th Amendment, there had been an income tax in place in the 1800s. However, the Supreme Court said it was not constitutional, and so this 16th Amendment was enacted and put into place in 1913. But again, not something we're going to have to cite to the IRS, but you do need to know that this is the top of the heap. So now we get to the practical top of the heap, which is the tax law itself, the Internal Revenue Code. Sometimes we just call it the code. It is the foundation of all federal tax authority, except for some occasional uncodified provisions and certain international issues that are covered in tax treaties with foreign countries. But for everything else, The Internal Revenue Code is the king. All federal tax law is codified into Title 26 of the United States Code. Probably good to remember Title 26. And officially, it is called the Internal Revenue Code of 1986. So every few decades, there is a major overhaul of the tax law done, and they will rename it for that year. And the last time an overhaul that large was done was in 1986. Trivia question: what was it before it was the Internal Revenue Code of 1986? Answer: it was the Internal Revenue Code of 1954. So there were 32 years between 54 and 86. Well, there's already been now 40 years between 86 and 26. So who knows when the next time they will do a large enough revision in order to rename the code again. Treasury regulations. A regulation is issued by the IRS and the Treasury Department to provide guidance for new legislation or to address issues that arise with respect to existing Internal Revenue Code sections. The Internal Revenue Code actually gives the Treasury Department the authority to write regulations which interpret and give directions on complying with the law. While the regulations are not technically the law, they do have authority that is very close to that of the Internal Revenue Code itself. So the Internal Revenue Code is not always very specific. And so the regulations get into the details about how to actually apply the Internal Revenue Code. And Congress will sometimes actually direct the IRS to write regulations. So they'll write a code section and they will put in there that the Treasury Department is to write regulations regarding this issue. Now, while we say that the regulations are very close to being the law, it is possible that the IRS could write something that a court later determines is not consistent with the Internal Revenue Code. So the courts can overturn a regulation in effect. They can say, no, that regulation, or at least that section of that regulation, is null and void because it contradicts the code itself. So judges can do that. Obviously, if the judge does that, then you would no longer be following that particular regulation. You would follow whatever the court said to follow. But the vast majority of the time, we can just treat the regulations as if they were the law. Regulations can be proposed, temporary, or final. So proposed regulations are open to public comment, and they may be revised and reissued several times or withdrawn altogether before becoming final. So when the IRS is putting out some regulations, they will put those out there to the public, and they will say, this is what we are proposing to do, to write for these regulations. We invite your comments. And then people can comment in writing back to the IRS. Then the IRS takes that into consideration, and then they may make changes accordingly. So who typically makes comments? Well, frequently it is tax practitioners. So it's practitioners who have clients who are going to be affected by these regulations. They will read through them, and then they will give their thoughts. Hey, have you thought about this? Or it seems like this is not a fair result in this particular situation, et cetera, and so forth. And they will give suggestions for what the IRS might do instead. Also, you may have industry groups. So let's say a regulation is going to affect, for instance, the trucking industry. Well, then the trucking industry groups may get together, read the regulations, and give their input on what they would like to see or what they think is fair, or other industry groups if it affects them. So that's the types of things that happen. There's this back and forth, and then the IRS can make adjustments. Then you'll have temporary regulations where the IRS will say, okay, we've got this regulation. It is temporary, so it will remain in effect for up to 3 years. So that's the number you'll want to remember for the exam, is that temporary regulations remain in effect for up to 3 years. The fact of the matter is we have got temporary, quote unquote, regulations out there that have been there for decades, and we still refer to them. Technically, you cannot rely on them. However, if that's all we've got, then that's all we've got. And so we will go ahead and use those and, quote unquote, rely on them. If you are representing a client, you can and should bring this up to the IRS if these temporary regulations support your position, but just know that they don't necessarily have to follow that if it has been more than 3 years since they were issued. And then there are final regulations. This is what we are really looking for. This is when they become official and permanent, quote unquote, permanent, until they might be rescinded. And these are the ones that you can follow as if they were the law, unless a judge has overturned part or all of them. Legislative history. So before bills become law, there is debate and discussion in Congress about the need for the legislation, the reason for enacting it. Much of that discussion and debate is actually codified in the congressional record and in other sources. And that history can give insight into the minds of the people who wrote and enacted the legislation and what their intentions were. And the courts love this. So they will often look to the legislative history when interpreting the law. So they're trying to figure out, what did Congress actually mean and intend? So the Internal Revenue Code has, believe it or not, relatively few words. Now, you may not believe that when you go and read how long some of these code sections are, but they really do try to be economical with their words and not include too much. But sometimes, of course, that then limits our understanding of exactly what they are trying to accomplish with the law. And sometimes the law may be vague. So regulations can help with this. That's one of the reasons we have regulations, is they can then take that law that might be a little vague and make it more specific with the regulations. But we don't have regulations for every code section. And sometimes the regulations themselves don't really specifically answer a question that may come up in the real world. So the courts will look at this legislative history. They'll say, what were the senators and the congressmen thinking when they enacted this? What were they trying to accomplish? And then the courts will interpret the law in light of that legislative history. So that history is available to you as well. And so you can get into that. And so if it supports your position, you can say to the IRS, hey, look, I know this language is not real clear, and maybe you could interpret it a couple of different ways, but here's what Congress was trying to do. And that is consistent with the way we have handled this on our tax return. And that can be a very persuasive argument for the IRS. And if it should ever go to court, very persuasive for the courts. Speaking of courts, next on our list is case law. So the courts interpret the law, and their decisions are written. They write out their decisions. The judge writes out their decisions, and they can hold considerable weight, especially the higher court decisions. So there is a hierarchy of the federal courts that you'll want to be familiar with. In the United States, the Supreme Court, the U.S. Supreme Court, is the top court in the land, and what they say goes. Underneath that, the next is the U.S. Circuit Court of Appeals, and there are actually several courts of appeals. There's not just one. Under that is the U.S. District Court, and there are several district courts as well. And then under that is the U.S. Tax Court. There's only one of those, and as the name implies, they only handle tax cases. And then there is also a U.S. Court of Federal Claims that sometimes hears tax cases. If the IRS loses a case, so goes to court, the judge rules in favor of the taxpayer. The IRS may or may not acquiesce to that decision for future situations, unless it's from the Supreme Court. If the Supreme Court rules something, the IRS doesn't have a choice. They have to follow it. But if it's any of these other courts, in most cases don't make it to the Supreme Court. So most cases are going to be U.S. Court of Appeals or lower. If the IRS doesn't agree, even after losing, then when future situations come up that are similar to that case that they lost, the IRS can say, we do not acquiesce to the decision in that case. We are going to follow our own interpretation, even though we lost in that case. So that means future taxpayers are going to have to sue and go to court and have the judge rule on their particular case. Having said that, even if the IRS has not acquiesced to a particular decision, if you're doing your research and you are talking to an IRS agent, you still want to bring it up. You still want to say, look, this court said this. Our fact pattern is very similar to that. So that's why we're taking this position. That agent may or may not then say, okay, and accept that. It's just going to depend on the circumstances. But you certainly do want to bring that up, even if the IRS as an organization has not officially acquiesced to that decision. Also, anytime you're dealing with a court case, you want to make sure that you are looking at the final version of that case. So in other words, it may have started in the tax court and it may have been appealed to the U.S. Circuit Court of Appeals. You want to make sure that you are looking at that final appellate decision, because obviously the appeals court may have ruled for or against what the tax court said. So you want to know that you are looking at the final decision. Now, usually when you're doing your research, you're going to be doing it online, and it will tell you that this case was appealed. It may even say this case was overturned on appeal, or it might say it was upheld on appeal. But you'll always want to look at that appealed case at the highest level where the case went. Obviously, you don't want to be dealing with a lower court case that ruled one thing that was later appealed, and then here you are talking to the IRS, and you're going to look like a fool when they say, well, you know, that case was appealed and overturned, and that means that you've been arguing exactly the opposite of what the court ultimately ruled. So that's just something that you want to look out for. IRS positions. So the IRS will state their position on issues via several different methods. You've got revenue rulings, revenue procedures, private letter rulings, technical advice memoranda, IRS notices, and IRS announcements. Those are all authoritative IRS positions. We'll talk about each of those. And then you've got the Internal Revenue Manual and IRS forms, instructions, and publications. Those are not authoritative, but they still do reflect IRS positions. So let's talk about each of these. The IRS issues revenue rulings and procedures to guide taxpayers in particular situations. So revenue rulings apply the law to a given set of facts, and taxpayers with similar facts can rely on them for guidance. So when you are talking to a IRS agent, if you've got a revenue ruling that is on point and is similar to your client's fact pattern, it will be very persuasive, because this is, after all, the IRS's own position. So if you can show them that their own position favors your client, the IRS agent is going to accept that. So what the IRS will do is they will take either a real example and then they'll sanitize it so you don't know who they're talking about, or they'll just make up hypothetical fact patterns, and they will say how a particular law, how that applies to this fact pattern. That's what revenue rulings do. You can rely on revenue rulings as long as they haven't been overturned. You can rely on them in a very similar way to how you rely on Treasury regulations. They don't have the weight of Treasury regulations. So if it goes to court, you can make an argument that, hey, I know the revenue ruling says this, but that contradicts what the code and or regulations say, so you, judge, should overturn this revenue ruling. You can do that. But still, as a practical matter, you can rely on what revenue rulings say, and you can apply that as if it were a regulation itself. Similarly, with revenue procedures, what revenue procedures do is they announce administrative practices and procedures for complying with the law, and they may be similarly relied on. So this deals with, the revenue procedures deal with the nuts and bolts of applying the tax law. So, for example, throughout this course, I've shown you inflation-adjusted numbers. So numbers change. The 2025 numbers are different than the 2024 numbers because they're adjusted for inflation. And the 2026 numbers will be different than the 2025 numbers. So where do we come up with all those numbers? Well, the IRS announces those in revenue procedures. So every fall, they will put out a revenue procedure that says what the next year and sometimes the year after that, what the inflation adjusted numbers are going to be. They will also put out revenue procedures, for example, about how to file a form properly or how to apply for a credit in the proper manner. So they will tell you the procedure for doing those things. So you can rely on that. Both revenue rulings and procedures are numbered by the year issued, followed by the sequence issued in that year. So, for example, the first revenue ruling of 2026 will be Revenue Ruling 2026-1. The first revenue procedure will be Revenue Procedure, or we say Rev Proc 2026-1, and so on and so forth. Private letter rulings and technical advice memoranda. These are very similar to each other. So a private letter ruling, these are issued to specific taxpayers who request advice about the tax consequences of a proposed transaction. They are then published without any taxpayer identifying information. So what happens is you have a taxpayer, and this is expensive. This is not something you can just do for free. It costs quite a bit of money in order to get a private letter ruling. So it's usually going to be a business or a very wealthy individual who's going to be getting a private letter ruling. So they can have a situation that comes up and they're not sure how they're supposed to handle it. So they want to get the IRS's input before they do it. They want to do it right. They're just not sure what right means. And so they're going to ask the IRS, what should we do here? And so the IRS will look at the fact pattern and then they will come out with a ruling that says, here's what you need to do. Now, it will say, right in that private letter ruling, it will say this can be relied on only by the taxpayer at hand. It cannot be relied on by anyone else. And that is true. However, if you've got these are published, so you can find them. If you've got one with a fact pattern that is similar to your client's fact pattern, it is still very persuasive. They don't have to follow it. But if you can show the revenue agent, look, here's a private letter ruling, and maybe you've got more than one with similar fact patterns. You can say, here, we've got 2 or 3 of these similar fact patterns. Here's what they say. That's consistent with what we are doing. That will be very persuasive for that revenue agent in general. Similar to a private letter ruling is a technical advice memorandum. So this is like a private letter ruling, except instead of being the taxpayer who is the one requesting it, it is the IRS themselves. So you've got an IRS agent in a local office who's looking at a situation and they're saying, I'm not sure how this is supposed to be handled. I've done my research, but I'm really not sure. So they will submit that to their IRS Office of Chief Counsel, who will then issue that technical advice memoranda, and they'll say, here's how you should handle it. And again, it is published, it is sanitized, so you don't know who the client is. And it will also say this cannot be relied on by anyone else. It's only for this one client. But it will be similarly persuasive if it is consistent with your client's facts and you can show it to the IRS agent. IRS notices and announcements. An IRS notice is a public pronouncement that may contain guidance involving substantive interpretations of the Internal Revenue Code or other provisions of the law. So notices can be issued relatively quickly and therefore may be the only guidance from the IRS on a particular subject matter until regulations can be issued. So regulations can take some time to get done. IRS notices can be done fairly quickly. So during COVID, when there was all kinds of new legislation coming out all the time, the IRS was putting out IRS notices to say, here's how to interpret this new legislation that has come out. So that's an example, but they can do them at any time. And you can rely on these announcements, just as you would rely on a revenue ruling or procedure. They don't have the same weight, and the IRS could actually later come back and issue a regulation that says something different than what that IRS notice said. But until that happens, you can rely on that IRS notice. The IRS announcement has only immediate and short-term value, so they may be used to notify taxpayers of impending deadlines or to summarize the law or regulations without making any interpretation of it. So the IRS notice will actually interpret the law and say, here's how to apply it. An IRS announcement might announce that, hey, there's this new law and here's what the law says, but it won't give you any interpretation or how to actually apply it. The announcement also might be used, for example, when there's a disaster and the IRS is saying, okay, we are going to extend the time to file or pay tax for people who are affected by this disaster. That, for example, would be done through an IRS announcement, and similar type of things would also be announced. Now we'll talk about the non-authoritative sources. So first is the Internal Revenue Manual. This is designed to serve as the single official compilation of policies, procedures, instructions, and guidelines relating to the organization, functions, administration, and operations of the IRS. So it's like an internal, quote unquote, internal manual for IRS employees. However, it is public. It is actually something that you can go and look at right now. It's at irs.gov/IRM, and it consists of 39 parts. You do not need to go and look at it for the exam. That's not necessary. You just want to know that it exists. However, at some point, you might want to jump over there and look at it and just scan through the different parts and the types of things that it involves. It can be very helpful. It gives you insight into what the IRS is looking for. So for particular issues, it will give the IRS agent who's doing the audit, for example, it will give them guidance on what to look at and what to be looking out for and the issues to consider. So it can be very helpful. And again, you cannot rely on this. So you can't say to the agent, hey, it says this in the Internal Revenue Manual, therefore you have to follow it. That doesn't mean I would never bring it up. You might bring it up anyway, but just know that they do not have to follow it. But for the most part, you're going to just be using it to get insight into what the IRS is thinking and what the IRS agent himself or herself might be looking at. IRS publications and forms. So, as you've seen throughout this course, I've referred many times to forms and instructions and IRS publications. And the IRS puts these out. They are based on the Internal Revenue Code, the regulations, the revenue rulings, but they are not authoritative in themselves. So you can't rely on them or cite them as support for a position. So IRS publications attempt to explain the tax law and rules in a digestible format, but they are somewhat simplified. So the reason you can't rely on them is because the IRS is not going to put every possible situation into the publications. They're going to put in there what applies most of the time for most taxpayers. So they are very helpful for us, but you cannot rely on them. The forms, of course, are how you actually file returns and elections and requests, etc. And the instructions explain how to complete the form. As we said before, the EA exam is actually based on IRS publications and form instructions. So even though they're not authoritative, I'm pointing you to them throughout this course because that's where the IRS gets the bulk of their questions from. Not that the questions themselves are stated in the forms and publications, but they use the forms and publications as the source for creating their questions. So you want to read those to have the information that you need for passing the EA exam. Also, if I was talking to an IRS agent, and let's say the instructions to the form said to do it a certain way, and then the IRS is now going to penalize my client for doing it that way. Well, even though the instructions are not authoritative, I'm certainly going to say, hey, look, Your own instructions said, this is the way you're supposed to do it. All my client did was follow the instructions. You can't penalize them for following the instructions that you gave. And obviously, that's a pretty persuasive argument. The IRS agent could be a jerk and say, well, we don't have to rely on those. But most of the time, they're going to say, yeah, you're right. It was wrong, but we won't actually penalize you for doing it that way. So, not authoritative, but you do still want to look at them. And sometimes you can defend your client or yourself. You might be the one who did the return and you were just following the instructions. And so you might be able to use that as a defense in that type of case. But in general, what we're going to use the form instructions and the publications for is to understand the rules and then to find out what are the authoritative sources that we want to use. So the publication might say, per Treasury regulation such and such, it's this. So then you want to actually go look at that Treasury regulation and cite that, or Internal Revenue Code section. You would actually cite that. You would not cite the publication itself. And then secondary sources. So these are the third-party sources, not authoritative at all, but they really can help guide you to the authoritative sources like the publications do. They can tell you, hey, go look at this regulation or code section or revenue ruling. And then they can also explain a topic and make it easier to understand. So they can put it in more understandable language. So you can read one of these research tools, one of these guides, and they can make it a lot easier to understand. And then you can put your argument together and go to the authoritative sources to cite those. So again, restating some of the companies you'll see, BNA, CCH, etc. There's also something called the tax book. So this is for those of us who deal with smaller clients, small businesses, individuals. It's a very handy source to just get some real quick information and to point you to the right direction if you need to do further research. So you can look at these things. Of course, they all cost money. None of them are free. You don't have to get all of them. So if you're going to get one of these, you can just pick one and use it. They are fairly expensive. The tax book is not that expensive. It's also, though, not as detailed as these others, but they are fairly expensive. So if you want to get one, if you want to invest in one, I'd just pick one that you like the most and rely on that one. The Internal Revenue Bulletin, we talked about this in the last video. It is the authoritative instrument for announcing official IRS rulings and procedures. And it also is where, of course, those censures and suspensions and disbarments of practitioners that we talked about are published. So they are published in the Internal Revenue Bulletin. It is also used for publishing Treasury decisions, executive orders, tax conventions, legislation, court decisions, and other items of general interest relating to taxation. It is published every week, and you can find it at irs.gov/IRB. Again, you don't have to look at it for the exam, but it is something you should probably go look at. You can see all of these Internal Revenue Bulletins. It's issued every week, so you can go back and look at them for years and years every week, but just go look at a couple of them, see the types of things that are in there, or if you want to see who's been censured or disbarred lately, you can go in there and look that up as well. Tax treaties. The U.S. does have income tax treaties with a number of foreign countries. Under these treaties, residents of those countries may be taxed at reduced rates or be exempt from U.S. tax on certain types of income. But it's very important to know that treaties do not reduce the U.S. taxes of U.S. citizens who happen to reside in that foreign country. So the tax treaty affects not U.S. citizens who are in that country, but citizens of that other country who are in that country. So it can give them a break on paying U.S. taxes in certain circumstances. It does not give U.S. citizens a break just because they happen to live in that country. Having said that, though, treaty provisions are generally reciprocal. So a U.S. citizen with income from that other country may pay lower taxes to that country. So it won't affect their U.S. taxes, but there's this reciprocity. It may affect the taxes that they have to pay to that other country. Our next topic is the statute of limitations. So a statute of limitations is the time period established by law during when the IRS can review, analyze, and resolve your tax-related issues. When the statutory period expires, the IRS can no longer assess or collect additional tax or allow the taxpayer to claim a refund. So it works both ways. There is a statute of limitations that the IRS has to assess or collect tax, but there's also statute of limitations that you as a taxpayer have in order to claim a refund. So there are three categories: the time that the IRS can assess tax, the time that the IRS can collect tax, and the time that the taxpayer has to claim a refund or credit. The IRS can usually assess tax within the later of 3 years after the return was due, including extensions, or 3 years after the return is filed. So, example 1, Aaron files his 2025 Form 1040 on March 31st, 2026. The statute for the IRS to assess tax is April 15th, 2029. So it's 3 years from the later of when it was filed or when it was due. So even though Aaron filed his return early on March 31st, it wasn't due until April 15th. Therefore, the statute to assess ends April 15th of 2029. Example 2. On April 15th of 2026, Byron files for an extension of his 2025 Form 1040 to October 15th of 2026. He then files the Form 1040 late on November 30th, 2026. The statute to assess tax is November 30th, 2029. So even though it was due October 15th, Byron didn't file until November 30th, so the IRS has 3 years from the date it was actually filed. There are some exceptions to this 3-year assessment date. First of all, if the taxpayer did not file a return, then there is no statute of limitations. So there's no statute until the return is filed. Once they file it, then it is 3 years from the date it was filed. If the taxpayer omitted 25% or more of their gross income from the return, then the statute is 6 years instead of 3 years, even if the omission was unintentional. So you had some income, you didn't realize you were supposed to include it in your tax return, maybe. It was 25% or more of your gross income. The IRS has 6 years instead of 3 years. If the taxpayer filed a false or fraudulent tax return, then there is no statute of limitations. You could have filed it 20 years ago. If it was false or fraudulent, the IRS can come after you for that. And then also, if the taxpayer and the IRS agree to extend the time to assess tax. So we mentioned this before, but you could be in negotiations with the IRS, and as part of that negotiation, you may agree to extend the time that they can assess the tax, and that is fine. The time limit can also be suspended in certain circumstances. So, for example, if the IRS issues a notice of deficiency, it's also called a 90-day letter, that stops the time. Because remember, they've got 3 years generally in order to assess the tax. Well, if they issue a notice of deficiency at 2.5 years, they have met their burden. They have assessed the tax within 3 years. Now, if they later rescind that notice of deficiency, then the clock will start back up. But if they do it at 2.5 years and now the clock stops, let's say a whole year later, they rescind that notice of deficiency. So it's been 3.5 years since that return was filed. Well, they've still got 6 months because that time period, the 3 years, was suspended. So now they've got 6 more months to do a new assessment. So that's how that would work. There can also be a suspension if the taxpayer files for bankruptcy. Remember, we said if they file for bankruptcy, then all assessment and collection efforts have to stop. Well, since they have to stop, the IRS is no longer allowed to assess tax. That suspends the time period. So again, they file bankruptcy 2.5 years into the 3-year statute of limitations. That is now suspended. And then once the taxpayer is out of bankruptcy, then that time would restart again. Collecting tax. The IRS generally has 10 years from the date the tax was assessed in order to collect the tax and any associated penalties and interest. That 10 years can also sometimes be suspended, or the time can be extended if the taxpayer enters into an installment agreement, which we'll talk more about in the next video. Again, if the taxpayer files for bankruptcy, if there's an offer in compromise that we'll talk about in the next video, or a request for a collections hearing, or a request for innocent spouse relief, or if the taxpayer is on military service, that can sometimes extend or suspend the time, or if they are living outside of the United States, that can suspend or extend the time as well. The main thing you will want to remember for the exam is it is 10 years from the date the tax was assessed. That, in general, is the time that they have to collect the tax. The time that a taxpayer can claim a refund. Generally, the latest a taxpayer can request a refund or a claim of credit is the later of 3 years from the date the tax return was filed or 2 years from the date the tax was paid. And again, if the return is filed before the due date, it is considered filed on the due date. So you file it on March 31st, it's considered filed on April 15th. So you've got 3 years from that date, from the date the return was filed, or 2 years from the date the tax was actually paid. It is the later of those. That's what you will want to remember, the 3-year, 2-year rule. And no rule would be complete without exceptions, and so here are the exceptions. If you are dealing with a bad debt or worthless security, if that's what you are amending the tax return for, then you've got 7 years from the return due date instead of 3 years. If you are amending to claim a foreign tax credit or deduction, then you've got 10 years from the original due date. So you'll want to remember those. 7 years for a bad debt or worthless security, 10 years to claim a foreign tax credit or deduction. If you have been affected by a presidentially declared disaster, then you've got 1 additional year, and that's when the IRS will put out one of those announcements to tell you that. If you serve in a combat zone or contingency operation, you may have more time to file. We talked about the specifics of that back in part 1. Or if you agree with the IRS in writing to extend the time. So remember, we said you might be negotiating with the IRS and you may give the IRS extra time to assess. A lot of times what they will do in return is give you as a taxpayer extra time to file a refund. So it's kind of a give and take in a negotiation. Amending tax returns. If an error is discovered on a return that's already been filed, it can be amended if it is within that statute of limitations. So the 3-year, 2-year, or longer if you've got one of those exceptions. If the return is filed before the due date, it is considered filed on the due date again. So you've got the time from the due date, even if you filed it early. Filing an amended return generally does not extend the statute of limitations for the IRS to audit the original nor the amended return. So this trips a lot of people up. Amending a return does not reset the clock. So a lot of people think if they amend it, now the IRS has got another 3 years to audit. That is not the case. That is not the way it works. Let's say you filed your 2022 tax return on the due date, which was April 18th of 2023. You've got 3 years from April 18th of 2023 in order to amend that tax return. So let's say you amend it in January of 2026. How long does the IRS have to audit that 2022 tax return. They have until April 18th of 2026, even though you just amended it on January 1st, 2026. It's brand new to the IRS. They haven't seen this before January 2026. Still, they only have until April 18th in order to audit that return and or the original return. There is one minor exception to this. If that amended return is filed less than 60 days from the statutory limit, then the IRS has 60 days from the date it was filed to assess tax, but it still doesn't extend it out 3 years. So let's say you have that 2022 return, you don't amend it until April 1st of 2026. Well, now the IRS has 60 days. So that's till what? The end of May, whatever 60 days would be. It'd be about May 31st. They only have until that 60 days, that May 31st, in order to audit that tax return. So you'll want to know those rules. If you owe tax, so you're amending, you realize you made a mistake, you amend, and you owe tax, this assessment statute still applies. So let's say you didn't realize until after April 18th of 2026 that you made a mistake on your 2022 tax return. So you want to be a good citizen. And so let's say in May of 2026, you amend your 2022 tax return and you send in a check to pay your taxes. The IRS cannot accept that check. They will send it back to you, or they will pay you your money back, because the statute for them to assess the tax has expired. They also cannot now audit that return. They can't say, well, they amended it. Obviously, there's a problem. We're going to audit it. They can't do it. Their time to audit that return has passed. So it seems counterintuitive that they would send the money back, but that is exactly what they would do. Now we will talk about some miscellaneous related issues to representing taxpayers before the IRS. Post-filing correspondence. Sometimes a taxpayer will receive a notice from the IRS after they file their return. There can be a lot of reasons for this, but some common reasons are taxpayer has a balance due, and they're saying, hey, you owe money, reminding you of that. Or the taxpayer is owed a larger or smaller refund, so they found an error, and they're saying you don't actually owe as much as you thought you did, or your refund is going to be smaller than you thought it was going to be for this reason. They'll explain that. They may just have a question about the return. They may need to confirm the taxpayer's identity if there's some question of fraud or identity theft involved. They may just need additional information for some reason. The IRS may have changed the return. They're just letting you know that, hey, we found a mistake and we changed it. There's nothing else you need to do. Or to notify of delays in processing the return. So we know we owe you a refund, but there's a delay, and so it's going to be some time before you get your money. They could do it for that. And there can be other reasons that they can send a letter to the client. So oftentimes you are going to hear from your clients when they get one of these letters and they are panicking because they get it and they don't know what to do. So if your client gets one of these and now you are looking at it, what should you do? Well, here's what you need to do. First of all, read the notice very carefully. This is not the time to skim or to speed read. Read it slowly, read it carefully. Respond if necessary, and it will tell you in the letter how you can respond. So you want to follow those instructions. Pay any amounts due. If you look at it and there are amounts due and you agree, so you say, yep, they're right, taxpayer owes this money, then you want the taxpayer to go ahead and pay that money. Again, it will say in the letter that you need to pay by a certain date in order to avoid additional interest and penalties. So you'll want to do your best in order to pay by that date. If the taxpayer cannot pay by that date for some reason, then you can contact the IRS in order to arrange a payment plan. We'll talk more about that in our next video. You always, of course, want to keep a copy of the notice. And if you are responding, so sometimes you're going to not agree with what the IRS is saying, or for some other reason, you're going to need to respond to that notice. So if you are responding, you can write up your response. You can put it just on your letterhead, send that in. You will also want to send a copy of the completed power of attorney, the Form 2848. So if you don't have one yet, you're going to fill one out, have the taxpayer sign it, you sign it, send it in with your response. Even if you already have one in place, always a good idea to put a copy of that power of attorney in with your response. So when they get it, they know that, okay, this person has the authority to speak on behalf of the taxpayer. Deadlines and timeliness requirements. As you have seen throughout this course, the IRS has deadlines for just about everything. Filing returns, responding to notices, filing for refunds, amending returns, etc., and so forth. These deadlines should be absolutely adhered to. If not, you risk interest, penalties, or non-acceptance of your filing. So they might just say, sorry, you missed the deadline. We're not going to accept this. Now, there can be exceptions to this, but usually they are published in advance, such as a natural disaster that says you've got extra time. And while some provisions do give the IRS flexibility to grant extensions or to excuse tardiness in some cases, most of the time they do not. So the IRS has to follow the law. So if the law says you've got X number of days to do something, then you've got X number of days to do something. The IRS can't change the law. They're just enforcing what the law is. They didn't make the law. So if they don't have that flexibility, then unfortunately, they're not going to be able to extend that for you. As we said in the previous video, the IRS may delay things on their side. Unfortunately, that does sometimes happen. But you do not want to be the one who is doing the delaying. And if the IRS is delaying and it's getting ridiculous, we will talk here in a little bit about what you might do to address that problem. FOIA requests. You may never actually deal with this in the real world, but for the exam, you need to know about this because it may be on the exam. There may be a question or two. This is the Freedom of Information Act. It was enacted in 1966, and it gives any person the right to access federal agency records or information, including those of the IRS. However, private taxpayer information is not available, nor is anything connected with an ongoing criminal investigation or other sensitive information. So yes, you can go to the federal government and say, I want this information. You have to tell me information. It's about transparency in government. But you can't go and say, I'd like to see the tax return of this famous celebrity or this famous athlete or this politician. They are not going to give you that. That is confidential information. And similarly, if there's an ongoing criminal investigation, they're not going to give you information about that. Also, many of the records that you might be looking for have already been made public. So the IRS makes lots of things public. You just got to do some searching. There can be online databases, et cetera, that are maintained by the IRS that you can already get access to without having to make a FOIA request. These requests can be made online on the FOIA portal. If you want a paper copy, then there's going to be a fee for getting those records. Usually, FOIA requests are made by journalists who are trying to get information. They're not made by tax preparers. The main thing you'll want to know for the exam is that they will not give out any private taxpayer information or any other sensitive information. That's really what you want to remember. Voluntary tax system. You may hear that the income tax system in the United States is called a voluntary system. And you might be thinking, doesn't seem too voluntary to me. So what do we mean when we say it is a voluntary system? It's called that because it relies on voluntary compliance. Taxpayers self-report their income and pay the tax rather than the IRS determining the tax and just taking the money. So you fill out your tax return and you send in the amount that you owe. So it is considered voluntary. Of course, though, if a taxpayer does not voluntarily comply, then the IRS does have the authority to assess and collect the tax due along with interest and penalties, and criminal penalties might also come into play. So it's kind of voluntary, not voluntary, but if you get a question on the exam, just know that this is what we mean by a voluntary tax system. Tax avoidance versus tax evasion. You will want to know the difference between these two. Tax avoidance is taking steps to legally lower your tax liability. So we all do this. If you contribute to a qualified retirement plan or a health savings account, if you deduct mortgage interests, if you deduct charitable contributions, all of that is perfectly legal. And a big part of our job as tax practitioners is helping clients to do this. So we're going to help clients to legally avoid as much tax as possible. Tax evasion, on the other hand, is a criminal act in which individuals and companies do not pay taxes that are legally due. Tax evasion is a felony. So tax avoidance is legally lowering your tax bill to as low as you can possibly get it. That's perfectly legitimate. That is a good thing. Congress actually puts into the law, they want to incentivize people and businesses to do certain things. So they put these provisions in the law because they want you to take advantage of them. So that's perfectly fine. But tax evasion is when you owe some money. So you've already lowered your taxes as low as you can lower them legally. And now you owe a certain amount of money, but you're not paying it. That is tax evasion. That is illegal. That is what we want to avoid. And so know the difference between those two. The Taxpayer Advocate Service. So the Taxpayer Advocate Service is an independent organization within the IRS. So if you get hung up on something within the IRS and you feel like you're banging your head against a wall, no one's listening to you, you're caught up in the bureaucracy, it can be very frustrating. So what can you do about it? One thing you can do is you can go to the Taxpayer Advocate Service. So they help taxpayers resolve problems within the IRS. They help protect taxpayer rights, and they make administrative and legislative recommendations to prevent and correct problems. And they really are good. This is legitimate. They are an independent part of the IRS, and they will help you. If the system is just not working correctly, they can help to get the system moving. They will also notice trends. So there is a taxpayer advocate office, at least one in every state. So they're getting input about different issues from all over the country. And they may see trends developing where the IRS is just falling down in their duties in a particular area. They will actually go to the IRS and say, hey, you've got a problem. You need to get this fixed. Or they'll go to Congress and say, hey, the IRS has got a problem. They need to get this fixed. So the Taxpayer Advocate Service can really come in handy in these types of cases. So specifically, what can they do? Well, they can help individual or business taxpayers when there's a problem that is causing financial difficulty to the individual, their family, or their business, or they are facing an immediate threat of adverse action. So maybe the IRS has already placed a lien on some bank accounts, or they're threatening to place a lien on some bank accounts. And now the taxpayer can't feed their family. They're having all these financial difficulties. They're trying to get it resolved. They've hired a representative. They're trying to get everything taken care of, but they're not hearing back from the IRS, and the IRS just isn't responding. You can go to the Taxpayer Advocate Service to help with that. Or if you've got any other situation where you've repeatedly tried to contact the IRS, but no one has responded, or they haven't responded by the date promised, you can go to the Taxpayer Advocate. Or if there's an IRS process, system, or procedure that just is not operating as intended, then you can go and try to get that resolved. Now, they cannot help you if you're just wrong. So they're not going to, if you owe the money and you don't like that you owe the money, you can't just go to the Taxpayer Advocate and have them magically make that go away. You can go through the normal appeals process, through the IRS, but the taxpayer advocate is not going to help in that case. They are there for when the system is just broken and something procedurally is not working correctly. The Taxpayer Bill of Rights. Did you know that as a taxpayer, you actually have certain rights, this Bill of Rights? Well, it is true. There are 10 of them. Now, you do not need to memorize this list, but read through it, be familiar with it. You may get a question, for example, that says, which of these is not one of the rights in the Taxpayer Bill of Rights? You just need to be able to pick out which one is not right. So if you're just generally familiar with this list, you'll be able to do that. So you have the right to be informed, the right to quality service, the right to pay no more than the correct amount of tax, the right to challenge the IRS's position and to be heard, the right to appeal any IRS decision in an independent forum, the right to finality. So once an issue has been dealt with, you have the right to know that you're not going to have to deal with it again. You have the right to privacy, the right to confidentiality, the right to retain representation, and the right to a fair and just tax system. So again, you want to be familiar with this, be able to identify something that is not a right. Taxpayer identity theft. Tax-related identity theft happens when someone steals your personal information to commit fraud. So your taxes can be affected if your Social Security number is used to file a fraudulent return or to claim a refund or credit. So here is what happens. We all know about identity theft, of course. And we all know that a lot of our personal information, probably a lot more than we would like, is out there somewhere in the recesses of the dark web. Well, what will sometimes happen is that criminals will get a hold of your information, including your Social Security number, and they will file electronically a bogus tax return with your name and Social Security number. And of course, it'll show a big refund, and they will direct the payment to go to their bank account. Once they have filed with your Social Security number, if you then go and try to file your own legitimate tax return electronically, it will be rejected because their computer system is going to say, there's already been a return filed with this Social Security number. You can't file another one. If that happens, then you are going to have to file on paper. When you file, you're going to attach this form 14039 identity theft affidavit saying, hey, someone filed falsely using my Social Security number. Then what will happen is the IRS will send you a PIN number to use to electronically file in future years. So next year and the year after that, every year they'll send you through the mail, through the regular snail mail, US mail, your PIN number. And then you have to put that into the tax software when you file the return for that return to be accepted by the IRS. This is one of the reasons I encourage taxpayers to file their returns as early in the tax season as possible. If they can get it filed in February, if possible, that will reduce the chance that a fraudster will file a return before they do, therefore blocking them and causing all of this problem. If the fraudster goes and tries to file a return after you've already filed your legitimate return, then they are not going to be able to file their fraudulent return. Also, you can get a PIN even if you've never been a victim of identity theft, just to prevent identity theft. You can ask the IRS for that. Go to irs.gov and you can see a way there that you can have a PIN sent to you. And that is the end of video 2, covering representation in general. In the next video, we will talk about specific areas of representation before the IRS, how those work and how you should handle them. So I will see you in video 3.